assets that we buy ourselves or we lease, and then looking at the cost we incur in borrowing money to finance that asset. Another thing we are supposed to talk about, we are going to talk about our assets, is what we call government grants. Now, what is a government grant? It's a common word, right? What's a government grant? Yes. What is a government grant? Or when you say a grant, what does it mean? Yes. But say, okay, so you say what is in your mind?
Like, okay, this one is out of the ground. Like, it's also, like, you know, our country, the money sometimes, the money they secure from IMF.
Yes. They come and dash them those money. So they will use it for developmental purposes. So it's a grant. Okay. So what about from business perspective? Now, sometimes this is what happens. Government, in order to encourage big people and businesses to expand and grow in some locations, government will make a great package for businesses to say that, okay, if you go and open a business in any part of the country, it will be maybe outrageous. So it's not Accra or Tema. It will be outside Accra. Then you open a business there, and the employees, you employ about 70, all your employees, you employ about 1,000 people, and 70% of the 1,000 people you are employing are from that vicinity. Then we as a government will give you an amount of money of say $200 million. That money becomes what? A grant to the business. It's an income that the business is receiving. But then there are two conditions that must be met before we can recognize that grant. So we want to open our business. So we are selling, let's say we're selling laptops or we assemble laptops. Then government has brought a proposition. Have you heard of Ghana's one district, one factory? Have you heard that? Okay, it's a policy that the government is doing where every district in locality, they want to establish factory there, so they employ people. So under this policy, government could say that, okay, any company that will go and establish a factory in one of those districts outside Accra, we will give that person $200 million. We will give. So the question is, if we go and establish the factory, how do we recognize this $200 million in our books? Two conditions must be met. So recognition criteria for government grants. One, the entity will comply with the conditions attached to the grant. The entity will comply with the conditions attached to the grant. The entity will comply with the conditions attached to the grant. That's the first criteria. So, open a factory. If you're employing 1,000 people, 700 should come from that community. So, if we open the factory and we are not going to be willing to employ 70% of the people from the place, then we have not fulfilled that criteria. Hence, we cannot recognize what? This grant. That's the first recognition criteria. Second is that the entity will actually receive the grant. The entity will actually receive the grant. So it is probable that the entity will actually receive the grant. Because some governments can promise you, and they will do promise and fish. So will we receive the money? So how do we determine whether the government will pay or the government will not pay? How do we determine? So yes, we are ready to fulfill the conditions. We have opened the factory and we are ready to employ the people. But the second one, how do we determine if the government will pay or won't pay? We can't. So is there no way we can figure that out?
Unless if the time period that they have given has elapsed.
But then you know that after the time we are recognizing, they might not have given us the money. I'll be getting it. They might not have given us the money. So sometimes you can use precedents. Have they done that to other companies? Did they give the money? Okay, the government, when they make promises like that, do they keep it? Do they fulfill it? So if it is certain that we're going to be receiving the money, meaning the two criteria is met or are met, then we can what? Recognize the government grant. So these are the two recognition criteria. The entity will fulfill the condition, and two, it is probable that the entity will actually receive the money. Now, when it comes to grants, the standard requires that there are two approaches that we can recognize the grants in our book. The two, I'll talk about the two, but one is what the standard says we should go for. The first one is we can recognize the grant as a deferred income. I hope you know when we say something is deferred, what does it mean? It's in the future. So we recognize it, but we're going to be spreading it over the useful life of the assets. So we can recognize it as a deferred income or treat it as a reduction to the assets. So if, for instance, the government says, okay, if you build a plant or you buy a plant which costs $100 million, we, the government, will give you a grant of $20 million to assist you in the cost of the asset. The standard is saying that there are two ways this $20 million can be accounted for. You can account for it as a deferred income. You can account for it as what? A reduction of the asset. Let me deal with this one because this one is simple. Accounting for it as a reduction of the asset simply means that, for instance, the cost of the asset, you debit the asset account, property, plant, and equipment, with 100 million, and then you credit maybe cash because you paid, or creditors because it's outstanding, with what? 100 million. Then this grant, because you are going to be receiving it, you're going to debit your cash if you receive the money, or receivables, $20 million. Then you will credit property, plant, and equipment with what? The 20 million. What does it mean? It means now your property, plant, and equipment has a figure of what? 80 million. And that is what you are going to be using to depreciate the asset. So that is the first approach. This approach is not what the standard actually advise businesses to use, because of the fact that, you see, sometimes today we can fulfill the condition, but going forward the business will see that some of the condition it can't fulfill. Now, if you can't fulfill some of the conditions, meaning that part of the grant would have to be given back to the government. In that case, if you had used this approach, then you'll be in trouble because it will affect your whole accounting system. But the next one is what is preferred, where you recognize it as a deferred income. So what does it mean when we are recognizing this as a deferred income? When we are recognizing this as a deferred income, simply what it means is that we're going to be debiting our cash, that is, we receive the money, or receivable, meaning we are yet to receive the money, with the $20 million. Then we will credit the grant with what? $20 million. Then we have $20 million. Number two, we can recognize it as a deferred income. In this case, what it means is that we debit the cash or the receivable account, and then we credit what? Grant account. Then we will allocate or spread this grant over the economic useful life of the asset. So if this asset we bought, the economic useful life of the asset is say 10 years, meaning that we are going to account for it in that order. So depreciation will be calculated first, and that will be 100 million over 10, and that will be $10 million. Then the grants that we allocate for that year, for each year, will be $20 million, also over 10, and that will be what? $2 million. So that every year we'll be moving $2 million from the grant account into the income statement. Does it make sense? So every year we debit our income statement with $2 million, and then, we debit the grant rather with $2 million, and credit the income statement with $2 million because this is an income that is coming into the business. So this is the preferred approach for recognizing what? The grants, using the deferred income approach. So I mentioned something that, why is this important? So go to your book and look at the last statement there. There is a note there. Have you seen the note? Note. If a government grant becomes repayable, it is treated as a change in accounting estimate, and I'll look at that later. The payment is first shown against any remaining deferred income balance. If the payment exceeds the deferred income balance, then the excess payment is treated as expenses. Let me explain that. So remember I told you that grants comes with conditions. So for 10 years, and the conditions are numerous. And so we've recognized this for say 6 years. Then in the 7th year we realized that part of the grant we cannot part of the conditions we cannot fulfill. And the government says that if you don't fulfill all the conditions, you pay 50% of the grant. So look at the conditions here. If you don't fulfill all the conditions, you pay 50% of the grant. What does that mean? That means that after the 6th year, now how much grant will be left in our grant account? 2 by 6. That will be 12. So the outstanding grant in the income statement as deferred grant will be how much? 8 million. Does it make sense? Now in the 7th year, we realize that we can't fulfill some conditions. And so government says that if you can't fulfill part of the conditions, you pay 50% of the grant we gave you. What the standard is saying is that that payment will have to be written off against any outstanding grants, then any excess will be treated as what? Expenses. So that 50% we will pay is how much? $10 million. Now remember this already has 8 million here. So what will be the double entry? We will debit the deferred grant with $8 million to cancel it out. Then we will credit our cash because we need to pay the government $10 million. Then the balancing figure of how much? $2 million, we will debit the income statement. This is what that statement there means. Simple. So that is what government grant is about. IAS 20. So look at the question there. Twiddle bought an item of property, plant, and equipment for $10 million and received a grant of $2 million. The property, plant, and equipment has a useful life of 10 years and has no residual value. Explain how the purchase of the property, plant, and equipment and government grants will be dealt with in the financial statement of Twiddle. In the financial statement of Twiddle. So how do we go about it? So, Twiddle. First, because I told you that when the question is like this, every grant question, we will use the first approach. We will treat the grant as what? A deferred income. So that is what we're going to be using. So first, we need to calculate depreciation of the assets. So depreciation will be 10 million over the useful life of the assets, 10 years. And that is going to be $1 million. Then, grants. So charge for the year, which is the grant, will be $2 million also over 10 years. What do we have? What? 0.2 million. So now, the question is, how do we account for this? Because it says, how do we account for this in the financial statement? So first, statement of financial performance, or the income statement. This is an extract. We bring our depreciation, of $1 million. That's a cost. Then we bring the grants. Government grants received or charge. That is what? 0.2. That is the income statement. Then we come to the statement of financial position. For the statement of financial position, what is going to be there? Under assets, we're going to have what? Property, plant, and equipment. And the cost is how much? 10 million minus the depreciation of 1 million. And that is left with 9 million. Then the grant will come, the deferred grant. And that will be under equity as part of the reserves of the company. So government grant, and that will be 2 million minus 0.2. 1.8 million. There you go. So this is how we account for the grants. Is it okay? Finally, about non-current assets is IAS 40. Property, plants, and equipment.